afternoon and welcome to this edition of Finweek Money Matters, the show that helps you manage your finances. I'm Nozi Pumbanjwa. Now, to help me steer the ship this afternoon, my co-pilots are Marc Ashton and Thandi Sizwe Mahluchana, Finweek editor and deputy editor respectively. Our lunchtime conversation today will consist of a look at the franchising space and what may be a potentially untapped market. With jobs and a possible withdrawal of investors on the line, we gulp into the storm brewing between government and alcohol producers as a halt in advertising may be on the horizon. We also pull in the rescue team as we have some insight for distressed businesses. All that and more coming up. But remember to send through any comments or feedback to moneymatters@abn360.com. Let's start things off with a look at our cover story. The growth of franchising in South Africa has been absolutely phenomenal, but it's also a sector with plenty of untapped potential. Finweek journalist Blair Bymester takes a bite out of fast food franchising to bring you the best investment bets. Could there be a sizzling opportunity there for you? Simone Cooper, head of franchising and enterprise development at Standard Bank, and Derek Smith, chairman of the Franchising Association of South Africa and the joint managing director of the Hot Dog Cafe franchise, joins us in studio. Thank you everyone for joining in this conversation. Derek, I'm going to throw this first question at you. Why are we seeing such an increased appetite for the franchising model in South Africa?
I think franchising is probably a very safe way of getting into business for the first time. The success ratio, well, it shows that, I think Rob Davies said the other day, that 5 out of 7 standalone SMEs don't even make it past the first year. But in franchising, it's the reciprocal. 90% of franchise outlets are still existing after 2 years. So I think people are, especially those getting into business for the first time, are saying this is a much safer route. You have support and protection.
Simone, would you concur with those sentiments? And particularly, I want to throw the question of whether entrepreneurs generally have a good understanding of what they're getting into when they try to adopt the franchising model. Is there a general understanding of what it takes to make it work?
Sure, it varies. There are some people who come in extremely prepared and they really have done their homework, they've researched the brand, researched what can be done for them. But there are other guys who also come in not researching anything, taking the first opportunity that comes along, and they really start to burn their fingers.
Of course, I'm sure, Marc, you have something to add there, but before you do, I want to throw in just a little curveball, because we've seen that the franchising model has been rather resilient, even in tough economic times.
Sure.
And I'm sure there's specific reasons for that. And maybe if I ask you, Derek, to share first, and if Simone, you've got additions, and then we'll come back to Marc.
Sure.
Well, again, you know, going through, we have a proven business model. We have strong brand strengths within those models. If you think of a Steers, a Debonair's, a Shell, a BP, you know, people trust those brands and they tend to buy from them. But you've also got a very strong support structure in your franchisor who's capable of sourcing product, because he can buy in bulk for large franchises. He can source the best costs, national marketing campaigns. It's all a matter of running really a big corporation through small SMEs to the joint benefit. And I think that's probably why we've seen the resilience.
From our perspective, it's really about the support that the brand provides. So generally, you've got people going into business, they don't have the skills, they haven't been in it before. It's a very daunting place to be all on your own. And with the support of a franchisor, you can really start to eliminate some of those risks. They help with financial management, all of the things that generally small businesses struggle with. So it's definitely a great opportunity for a small business owner.
Okay, but then you talk about them coming in and without experience and simply adopting the franchise model. Doesn't that still present risk, though, that if somebody hasn't actually tried to run a business before, they haven't burnt their fingers, they haven't got any kind of track record to look at, does it not worry you that you're taking on somebody? I understand the benefits, but does it not worry you from an experience perspective? Or maybe turn the question around, is it still important? You can't just assume that if I walk out of here today and say, great, I'm going to start a Steers franchise, does that make me any more capable of running the business than if I hadn't picked a Steers franchise or something existing?
Yeah. We generally work very, very closely with the franchisors themselves. So we're looking at very, very strong brands that are making sure that they're picking the right candidates and that they're also providing the right training. So there are a lot of brands out there who aren't necessarily doing the right training, who aren't providing the right systems and processes. So we generally take a steer from the work that we do on the franchisor itself and understand their systems and processes. So they will send guys through very long training programs, they will accredit them. So by the time we're seeing the guys that are coming through, they generally have been screened for general business acumen, and there's a lot of things that will make it more successful than just a normal startup.
Yeah.
There is also the point, you've got a proven business system. You actually don't want franchisees that change and mess around with that system. So in a way, someone who has not been in business before is like a fresh piece of paper.
Sure.
And they won't mess with the system as easily.
I suppose one thing I want to throw back to you again. So, I mean, we've seen, for instance, Rhapsodies in the news recently,
Yes.
and this is the kind of thing that worries a lot of people when they hear the franchising thing. And you know, there's a lot of a glamour factor to running a restaurant of the Rhapsodies
Yes.
nature, but the systems weren't in place there, and yet you've had a situation where a lot of people have been led to believe that these systems are there and the financial controls are in place. Basically working on what's in the media at the moment, those controls weren't there. How do you turn it around from the perspective of both the lender and the potential franchisee? How do they know that they're getting into a proven business model where they do have what they claim to have?
Yeah, so we encourage all of our clients to do their own homework. So we've obviously done a host of homework on the brands themselves. There are instances where you might not pick it up. So, you know, from what I understand from the Rhapsodies case, from what's been reported in the media, it's a case of there's quite a lot of fraud involved, which you might not necessarily pick up from doing your homework. So there could have been things, but there generally are warning signs. So it might be rosy when you get in, but there generally are warning signs that things are deteriorating. So it's about being aware and constantly communicating with the franchisor and checking that things are what you thought they were, and seeing how things go from there.
Mark, if I might add to that, I know a little bit about the Rhapsodies case, and there the actual operating units are pretty viable,
Right.
As much as any franchise. There is allegations of serious fraud. Now you can write a law saying thou shalt not murder, but it doesn't stop people killing people. And similarly, if a guy is going to break the law and defraud people, that's beyond setting the rules.
Fair enough.
And I think that's where one of the problems. There was a bit of naivety, I think, as well, is that when it was suggested that the systems be broken, the franchisees went along with it by trusting the particular gentleman. So I think, you know, it was more a fraudulent problem than it was a systems problem.
Okay, fair enough. I guess one of the other things that then comes in is a lot of capital. Franchises tend to be quite capital intensive, particularly when you look in the fast food space. I know that there are some of the smaller ones, but typically, you know, you can be looking $500,000 to $1 million just to get your foot in the door. How much of that it should be an unencumbered capital that when you're looking at it from a lender's perspective?
From a lending perspective, we generally take our steer from the franchisor themselves. So they generally or typically are looking for 40 to 60% unencumbered capital that comes in.
Right.
So we will, if it is a first-time store owner, so somebody who's coming into franchising for the first time or has got other businesses and this is their first one, we would look towards those guidelines. There are instances where you might go lower than that if it's somebody who has got multiple businesses and multiple stores and they've built up a lot of equity in that. But we are generally guided by the franchisors. They've tested the models, they understand how much you can gear the business and how much you can't.
What about there seems to be the argument, whenever you talk to the franchisors themselves, they tend to talk about this owner-manager model where the owner's in the store the whole time, and maybe Derek can also give some input here as well. But then you talk to those that make a real success of it tend to operate multiple stores. So how do you guys view that from a risk perspective? You know, should the guy be sitting in his store, the store that he owns, and sitting on top of it the whole time? And how do you manage that from a risk perspective? And then I guess from an operational perspective, how do you manage that where you've got multiple franchise operations?
Do you want to go first?
All right. So from a risk perspective, obviously we encourage the owner-managed model. It means that the store owner's on site, he's got his finger on the pulse on what's going on. You know, particularly in retail and restaurant industries, there's a lot of theft if you're not on site. So if there's a first-time franchisee that we're looking at, we would generally look at someone to be owner-managed. However, once someone has made a success of one store, it is possible for them to expand into other stores. So we will look at how successful they've been, what controls and what systems they will put in place into the existing stores once they go and acquire new stores. So it's really, each case is assessed on its merits, and each one is done individually. So you'll look at the entrepreneur themselves, the brand that they're within, what they've said, how successful they've made their existing store. So it's really dependent on their previous history in that instance.
Okay. I think also there's personality. It doesn't matter whether it's franchising or it's any other form of corporation. You get certain guys that are very good at running one operation, but they're not very good at delegating to management to run 2 or 3 operations. I think that's a very important factor. It's the nature of the animal as well. Certain franchises lend themselves to be managed at more arm's length, some don't. I mean, for example, a Rhapsodies, you quoted Rhapsodies, that is a very complicated animal. It goes all the way from preparation of butchery meat through to processing, through to alcohol, through to, you need to be hands-on, you need to be in the store, that's for sure.
Derek, there's a very interesting trend that I want to pick on, and this is the collaboration that we're seeing between fuel franchises and retail franchises. You know, what are the benefits of going it that route?
Well, in America, this has always been a big thing. It's maximising the space. They have the petrol stations have the foot traffic by its very nature, but it's also a convenience point. I mean, you know, traditionally we used to go to large centres like the Menlins of the world and things like that, but that's quite an effort. Whereas if you can pop down the road, call into your engine and go to a Woolworths at the same time on the way home and grab your supper, it's convenience. Now to the franchisee, it's just adding value. I think margins on petrol are getting tighter, and they're looking for other forms and sources of income and just maximising the space.
Is it a less risky approach, Simone?
Well, certainly once you're maximising the space and you've got a convenience store and a quick service restaurant and the fuel site as well, it certainly means that you've got more income coming in. So from that perspective, it's definitely less risky. However, you have to have the right person in place so that they can manage all of those operations, because fuel and quick service and a convenience store are very different businesses.
I would like to look at the relationship between the franchisor and the franchisee. Obviously, it's a very long-term relationship, and I want to look at. I want to chat quickly about the control that I, as a franchisee, have over my store when there are things such as refurbishments, new look and feel and stuff like that. And if I, at the moment, I don't currently have the cash to do, to carry out such an exercise. How much control do I have as a store owner to say, actually, I just don't have the money to buy new couches, to get new cups or new glasses, fancier ones, etc., etc. Where and how do we reach a common ground in that respect?
Do you want to take this one?
I can understand the difficulties in that one. I mean, Christo Carlitz faced it when he revamped Wimpy. It was a magnificent thing. In fact, I chatted to him about it and I said, how did you do it? How did you persuade guys that were breaking even or losing money to reinvest another $500,000? And it's simple. What the franchisor did in that particular circumstance is it did a pilot store itself. It proved to increase profitability or turnover by 30%. And people are not silly. When they see that type of thing, they want part of it. It's necessary. I think a good franchisor will also come to understand a franchisee's problems, and although insist on the revamp, because you're only as strong in a brand as your weakest outlet, they might put it over time. They might do it more slowly. They might give terms. They might, there are ways to get through it. But revamps are generally there to improve profitability, to revitalise the brand, and to increase turnovers.
Is that something you would play a role in as a lender? Absolutely.
So we would look to finance a portion of the refurbishments, depending on the brand, again, depending on the business itself. We'll see what sort of repayment ability there is, and we would definitely look at that.
Do you, Derek, do you get the sense that the franchisors are actually taking advantage of the franchisee? And it's a very general question, but you look at the situations like McDonald's at the moment, where they're actually getting huge pushback from their franchisees because they're being squeezed tighter and tighter, and times are tough at the moment. You look at Woolworths, they've been taking the stores back from it. It almost feels like the loyalty seems to be disappearing from the value chain in places.
I think there's two aspects to this. I think a franchise only works where both parties are making money or losing money equally or investing money equally, because it's a partnership. And the moment you swing the profitability to one side or the other, that franchise is doomed, in my opinion, because everybody's got to go home and be able to feed their families and make a living. I think with the McDonald's situation, you have an added complexity. Once you become a publicly listed company, then the pressures of the JSE come on your shoulders, and then you've got to produce quarter after quarter. And sometimes that may or may not, I'm not saying it did in that situation, it may just create some over-enthusiasm in ways of producing a quarterly profit. So it's a very good thing to be a quoted company in some instances, because you can raise cheaper money and grow. But it adds another strain to that relationship.
I think we've just only scratched the surface of this particular conversation, but unfortunately we'll have to wrap, and I think we should, Marc, definitely bring franchising back. Thanks to our guest Simone Cooper, Head of Franchising and Enterprise Development at Standard Bank, and Derek Smith, Chairman of the Franchising Association of South Africa and the Joint Managing Director of the Hot Dog Cafe. Remember that Finweek is available on shelves today in both English and Afrikaans, and is also available digitally at mysubs.co.za. Time now for a quick look at our Finweek Trade of the Week. This week's trade of the week is Clover. So, Marc, we know that revenue is up, earnings per share are up. We hear the CEO also talking about expansion plans into Southern Africa. What do you make of those pronouncements?
Look, I think Clover's an interesting business. I think now that it's come to the JSE, they've got rid of the old co-op model. There are still some underpinning shareholders in it. But Clover's an interesting thing. They always say buy beer and bread. Those are kind of strong points. You could probably throw dairy into that, because dairy's been a phenomenal, milk in particular has shot through the roof. But Clover's a good business, and relative to the likes of your Tiger Brands, your AVI, etc., Clover looks cheap. They're putting a lot into their capital expenditure at the moment. They are going into the rest of Africa. They lost a lot in their margins in the fiscal first half of 2013. Seem to be clawing that back at the moment, and it looks like there's probably some upside here. If you're a value investor, you get a relatively cheap share, you get dividend yield out of it. It looks like there's something to be seen here.
So it's a definite buy in your books right now?
Definite buy right now.
Definite buy. So that was this week's Trade of the Week. Time to pay the bills. We'll be right back after this short break. Welcome back to Finweek Money Matters. The new draft control of marketing of alcohol beverages bill will go before Cabinet shortly and could have a material impact not only on the advertising industry but also on sponsorship of sports events. This could negatively impact the country's economy and job creation. As we take a deeper look at what is brewing below, Joey Heshu, spokesperson for the Association of Responsible Alcohol Use, is in studio today. Joe, thank you so much for making the time to join us. Now, of course, the biggest question is the number of jobs that are likely to be lost indirectly or directly should and if this bill is passed. How are you tackling that question?
Just to illustrate the facts, in alcohol industry supports about 548,000 jobs. Through the control of marketing bill, about 12,000 of those jobs would directly be at risk. About 4.3 billion in direct expenditure will be at risk. But I think our approach to it is to seek collaborative solutions with the government, is to seek for more consultation. And under any normal policy making process, there would be consultation. You'd find that government would be calling industry, would workshop some of the policy options, but that's the difficulty we have here. Whilst we are sort of ready to look at the policy options, we have no one to negotiate with.
But that's my issue, is there actually somebody that's spearheading this, and are they prepared to discuss it? Because we seem to have a lot of issues around economic policy at the moment, which seems to blanket decisions get made, and it doesn't seem to think about who gets impacted by it. Is there somebody you can talk to?
Well, the alcohol industry is regulated under the National Liquor Act of 2003, Act 59, which sits with the DTI. However, the bill is coming through the Department of Health because it's being treated as a public health issue. Now, we acknowledge that there's a lot of public health issues around alcohol misuse. However, it is at the end of the day an economic and trade enterprise. So surely the DTI would have a role to play, the Department of Economic Development, even Treasury. I mean, out of total tax revenue, I think we form about 6.7%. So you'd think there'd be a whole multiplicity of players being consulted, and I don't think we've got good with that yet.
Do you think that there's, sorry, I just want to jump in here, but do you get the sense, will it change things if there's will it change the social impact if we spend the marketing of alcohol?
In other words, will we all, us three, drink less? If,
We're journalists, let's be honest.
will we be drinking less if there are taxes and levies put on these items?
You know, it's a contentious issue. And depending who you ask, you'll get a different answer. Sure. We see no direct link between consumption and advertising spend. And what we are trying to do when we spend money, because that's the question naturally one is going to ask, so if it doesn't affect consumption, why are you spending money? I want to know if the three of you are buying drinks, I want you to buy my drinks. Sure. And that's why alcohol companies spend money in advertising. And keep in mind, majority of South Africans do not drink, and no amount of advertising is going to make them drink. It's a predetermined choice. Now, I understand that there is an issue around young people, specifically the youth, underage persons. Does the way in which alcohol advertising is done entice them to drink? And that's why the industry has got codes that are directly meant to prevent exposure of underage persons. If the call is for us to improve that, then we stand ready to do that. But let's have the right discussion.
I want to go back a little bit, and I want to look at maybe a historical comparison. If you look at the tobacco industry, and I remember growing up, and there used to be the Rothmans Cup, and I knew that was tobacco because my dad used to smoke Rothmans at the time, right? And I don't see that anymore. But would taking away alcohol advertising open up sponsorship for other advertisers to come forward? Because irrespective of whether Rothmans is there or not, you have the Casalaga Cup or calling Black Label Champion Cup instead. So is there a strong case for saying that, well, advertising isn't necessarily going to be impacted because it opens space for other players?
Around the time the tobacco bill that was happening, a number of changes were happening in advertising. One, you had telecommunications companies entering the space in a very aggressive manner. You had also a change with the banks also amping up their activity in the advertising space. So they sort of filled the vacuum that was left by tobacco. In this particular instance, I don't know who will fill that vacuum. If somebody else does, maybe we should have a discussion. But I'm keen to know what's on the horizon for that.
Sure. I think that's an interesting thing, and I just want to go back to what Marc was saying in terms of the collaboration between all the players and who's spearheading this whole thing. Currently, it's led by the Interministerial Committee of the Department of Health. And the interesting thing is, with all this debate and discussion going on, the Minister of Sports, Arts and Culture, Mr. Fikile Mbalula, has actually been, looking eye to eye with the Minister of Social Services, because Mr. Mbalula himself has actually said that this is not a good bill because, one, it's going to make sure it's going to, result in losses in terms of sponsorship, and therefore it will impact on his work as the Minister of Sports. So there are disagreements within the government sphere as well, which just goes to show that, this thing needed to have to be given the time, for all the relevant players to sit down and actually try and find the right solution.
It's not just the Minister of Sport who's facing a problem. The Minister of Communications would have a similar problem, in that the SAB would lose about 500 million in revenue that they get. There's also for other broadcasters significant losses there. And you'll remember that the Minister of Health at some point did suggest that he would fund the Department of Communications and give the SAB the budget shortfall, which I don't think is the direction we ought to be going. But that being said, they've also made a proposal to say that an additional levy must be introduced to raise funds for the vacuum that will be created in sports. And I think they propose a 2% levy,
Yep.
which would raise about 1.5 billion rands to replace 4.3 billion. Again, it's not enough. And secondly, Treasury would never support a ring fencing policy, because once you've set the precedent, then you're going to start to look at the fuel levy and plastic levy and everything else. And I don't think we are in a space where we want to ring fence budgets.
Joe, let's look at the regulatory framework just for a second. I mean, I understand with regards to advertising, we probably can regulate that, but we've proven over time and time again that we don't necessarily have the muscle to enforce the legal drinking age and whether people should be drinking and not driving, and that's something we seem to have been losing over time. Should the bill be passed, do we have the muscle to actually enforce all that comes under it?
From an industry perspective, and this is one of the criticisms that have been leveled against industry, that we are not implementing the self-regulatory codes that we have. Fine, let's go into a co-regulatory model. So now, in that space, there's a lot of modalities and a lot of modeling that needs to be done to ensure, one, you can enforce. Secondly, it doesn't become cumbersome that you can't do business. And I think that's exactly the conversation that we want to get into government and say, okay, fine, we're moving into a co-regulatory environment. What does it look like and how do we make it work? Because right now, you're quite correct. There is a legal purchasing age that's not being correctly enforced. There is a blood alcohol content level that is not being enforced adequately. So let's start having that discussion.
In looking at that self-regulation, regime, if you will, so the World Health Organization released a circular, I think, about 2011, obviously recognizing the ills that are brought about by huge alcohol use and huge alcohol consumption. And countries like France have actually sort of excelled in terms of self-regulation. So you'd have things like, they won't advertise alcohol in places like cinemas.